Okay, then comes a related concept which is called APV approach, adjusted present value approach, concept 17, adjusted present value approach. Now, what is this APV approach? Let's understand this first. We Whenever you do project, one core principle is you should not mix financing decision and investment decision together. That is, when I'm evaluating an investment decision, I should see whether the project is able to generate adequate cash flow and it is self sufficient on a standalone basis. Suddenly one project is bad, what owner says is, I will give loan to the company, I'll give loan to the company at 1% rate of interest. Cost of debt will be lower, cost of capital will be lower, suddenly project becomes a better project. So one core principle is, investment decision and financing decision should not be mixed together. Most of the question we did, nowhere the question had mentioned where is the money coming from. You only saw where is the money going. You never saw where is the money coming from, and one cost of capital was given, you are just taking that and proceeding ahead. APV approach says no, we can mix them together. We can mix them together in certain, because of certain benefits. Now, first let's assume I'm going to put up a project in a rural area. When I do a project in rural area, government says put up a project in rural area. I did NPV. NPV is negative. NPV is negative. Then government is saying no, no, you do the project because you put it in a rural area. I will give you a loan at a very low rate of interest. I'll give you a loan at a very low rate of interest, and this can change your analysis significantly. So APV approach comes into picture when there are certain allied benefits of taking a borrowing, certain allied benefits of taking a borrowing. One of the allied benefit is obviously the tax benefit, because on the debt you pay interest, on the debt you pay interest, and interest is a tax deductible item, and as such that tax benefit is also considered in WACC calculation. In the WACC calculation, you take after tax cost of debt. Then what did APV approach say? First they said you assume 100% equity funding. You assume 100% equity funding. No money coming from debt, guys. No money coming from preference, guys. All money is coming only from equity, guy. And calculate the base NPV assuming it is 100% equity funded. Base NPV at what rate? At cost of equity. Discount it at KE and calculate. We know one concept that K is always greater than KO. K is always, or at base it is equal. Otherwise, K is a costlier item. KD is a cheaper item. Cost of debt is a cheaper item. Cost of equity is a costlier item. So I did the project. You told me to do the project. I did analysis. NPV negative 500 lakh. NPV negative 500 lakh at what approach? Base NPV assuming 100% equity funded. Assuming 100% equity funded. Then they are saying no, no, there is a benefit of debt financing. There is a benefit of debt financing. Now we are going to mix two things. Earlier till now, nowhere we mixed it. Any problem you have done in the previous session or today, whatever problems we solved, we were just doing a project. Nowhere you asked us where is the money coming from. Last approach, long-term fund, equity shareholder only introduced it, and this expands that approach. The APV approach is an expansion of that approach. So what I do here is, I have to separately calculate present value of tax saving on interest. That is, now you decide, say that 500 crore project, 300 crore will come from debt. On the debt, I pay interest. On the interest, there is a tax saving. Calculate tax saving of first year, second year, third year, fourth year, fifth year, sixth year, and do the value. If it's a irredeemable debt, Modigliani Miller, benefit of debt is debt into tax rate. Benefit of debt is nothing but debt into the tax rate directly. Debt into the tax rate directly is the benefit of the debt. In case you are paying interest every year, no problem. First year interest, second year interest, third year interest, fourth year interest, fifth year interest, and get the tax saving component and do discounting of it. Do discounting of it. At what rate it is discounted, I'll touch upon as we proceed. So this is first part. Present value of tax saving on interest. I did this till the project is rejected. Still the project is rejected. Then government said, normally you take a loan at 12%. I'll give you a loan at 8%. I'll give you a loan at 8%. So there is a 4% interest saving. One, there is a tax saving. Second, there can be a interest saving. Get the present value of the interest saving. Get the present value of the interest saving. Interest saving will come into picture when government wants us to put up some project in a rural area. Project on a standalone basis is bad. Project on a standalone basis is bad. If I have to put up a plant in a rural area, maybe on a standalone basis project is bad. A backward area, lot of income tax exemptions are given for backward area investment. GST, certain benefits can come. Similarly, government gives power benefits, power subsidy, and they also end up giving interest benefits. They also give interest benefit. Government, in fact, many I have seen practically that you will do the loan also, you take it, you pay interest to SBI, government will refund 4% interest, 5%. That's called interest subsidy. Government is going to give me interest subsidy. Why is it giving me interest subsidy? To make the project little attractive. Otherwise, project, nobody is ready to put up a plant in a rural area or in a backward area. Nobody wants to put up a plant. So I explained it, you understood it, you save interest, lower interest payment. Get year 1 number, year 2 number, year 3 number, year 4, year 5. These are discounted at pre-tax cost of debt. This is where a lot of confusion happens. Pre-tax cost of debt. This is the most important explanation. What is pre-tax? Why it is pre-tax cost of debt is, one principle of any analysis is any cash flow has to be discounted. Any cash flow has to be discounted at the risk which is there in the cash flow. At the risk which is there in the cash flow. Gambling business will have a higher risk, higher discount rate. Normal business, lower risk, lower discount rate. One core principle is high risk businesses, high risk cash flow, higher discount rate. Low risk business, low risk cash flow, lower discount rate. The tax saving on interest and the lower interest saving comes out of the debt which I take. Comes out of the debt which I take. And if I want to know what is the risk of the debt, the risk of the debt is equal to the interest rate which you pay. How is it linked? If I take a loan, you will say 10%. SBI takes a loan from you, you are saying 7%. Government takes a loan, you are saying 6%. So the rate of interest which you charge on my loan is different. SBI, when you give a loan to SBI, basically you create a FD. You create a FD, indirectly you are giving a loan to SBI. So the rate of interest keeps changing. So what APV approach said is, which is a very logical approach, that whatever cash flow you generate because of the debt financing benefit, those cash flow need to be discounted at the risk which is there in the cash flow, at the risk which is there in the cash flow. How do I decide what is the risk in the cash flow? Please ask what rate of interest are you going to charge. Please, normal rate of interest, not the lower rate of interest. Normal rate of interest. What rate of interest are you going to charge? Our question may give the pre-tax cost of debt. They may give the pre-tax cost of debt. Again repeating, it has to be at the pre-tax cost of debt and not at the post-tax cost of debt. I have explained it multiple times, but still, because one disconnect which happens is I say tax saving, then I say pre-tax, so students keep getting confused. Logical explanation is this. Still you are not getting clarity, just remember it and go ahead, because I try to complicate it further, you will not understand it. One logical explanation is this. Any cash flow has to be discounted at the risk which is there in the cash flow, at the risk which is there in the cash flow. If some cash flow carry higher risk, higher discount rate, carry lower risk, lower discount rate. If I am going to put up a project and that money is going to come from Government of India, demand is guaranteed by them, my expenses are guaranteed, my depreciation is guaranteed, tax rate is guaranteed. If everything is guaranteed, I'll discount at RF, risk-free rate of interest. I'll discount the entire project at RF at the, provided everything is guaranteed. Sales is guaranteed, cost is guaranteed, depreciation is guaranteed, your interest is guaranteed, so your tax rate is guaranteed. Any changes can happen, then RF will not work. Any changes, tax rates can change in the practical world, then risk-free rate will not. If there is a guarantee on everything, then there is zero risk in the cash flow. Zero risk in the cash flow. Please go ahead and discount it at risk-free rate of interest. So here I have to discount it at pre-tax cost of debt. this will increase my base NPV. This will increase my base NPV. But one item will decrease it. What item will decrease is, till now we said we are doing a 200 crore project. Last problem we did. You said 200 crore will come from equity guy, debt guy, all that you did everything proper. But to raise that 200 crore, practical world, I may have to incur 2-3 crore as flotation cost or as issue expenses. Nowhere we were analyzing that. Nowhere. This approach mixes them together. This approach mixes them together. So what it says is base NPV plus the benefit minus the issue cost. Minus the issue cost is called adjusted NPV. Minus the issue cost is called adjusted NPV. We are mixing two elements together here. We are mixing two elements together. Why am I mixing these two elements together? To consider the debt financing benefit, also to consider the cost of raising the debt as well as equity. It could be debt, equity, whatever cost is incurred to raise the money. We were not interested in mixing them together earlier, but this concept says please mix financing decision and investment decision together. Why not mixing is preferred? Because that is a simple approach and that gives me a right conclusion. When I mix them together, project is not getting good NPV. You suddenly change the interest rate, you suddenly change the KE, you suddenly change the KR, you suddenly change the KO, you try to play around it and suddenly show it's a good project. I change the KO, it can become a good project. How can I change the KO? By reducing the interest rate. Or on the equity side, I suddenly say we will evaluate like this and KE changes. So you can play around with the numbers the way you want. But what concept says is, let's not get into all that. You give me a project, tell me the risk of the project through its asset beta. Tell me the risk of the project through its asset beta and tell me the cost of capital and let's be done with it. I don't want to bring in this equity financing, debt financing, equity guys bringing so much, bringing all that analysis is not needed, which is what we have done in 20 problems till now. But suddenly one problem, last problem I did, no, we will bring in the mix of equity and debt, which was and an expansion of that is the APV approach. An expansion is the APV approach. Adjusted present value, NPV under APV approaches, base case NPV minus PV of issue cost, PV of debt financing benefit. Base NPV is computed at unlevered cost of equity. Unlevered means zero debt. Unlevered means, levered means debt company. Unlevered means no debt company. Unlevered is no debt company. PV of debt financing benefit comprises of tax saving, lower interest rate due to some subsidy. This needs to be discounted at pre-tax cost of debt. I have explained to you in the past batches also I have explained, but students still somewhere have a logical disconnect. Reason is because one item you see after tax, one item you see pre-tax. That logical disconnect was there with few students. I've tried explaining again. If you're not able to get it, you can ask me after the class, but still not able to get it, just remember this, that's all. It's pre-tax cost of debt. It is only pre-tax cost of debt. If it's a perpetual debt, benefit is equal to debt into tax rate, which is the Modigliani-Miller approach. At inter level, you would have learned value of unlevered firm, value of levered firm. Levered firm is unlevered firm plus amount of debt into tax rate. A company is taking a loan at the rate of 4%. Their normal rate of interest is 7%. So you save 3% interest. You save 3% interest. So interest saving 10 lakh into 3% every year. 10 lakh into 3% every year. And you are paying 4% interest. You are paying 4% interest. On the 4% interest, you save 4 into 30%. You save 4 into 30%. This has to be discounted at pre-tax cost of debt, which is normally 7%, which is the 7%. So in this calculation, what has happened is I did a project, base NPV negative 1,50,000. You add this and make it as a positive NPV and do the project. Make it as positive NPV and do the project. On a standalone basis, project will mostly have negative NPV. Government to encourage would give this. If this is eliminated, again it can lead to negative NPV. If interest saving is eliminated, again it can lead to negative NPV. So one is interest saving, second is tax saving. Both are there. In case a company is paying no taxes, tax saving part is eliminated. Tax saving part cannot come if you're not paying any taxes. Then taking a loan is not viable. The loan cannot give you any tax benefit. The loan cannot give you any tax benefit. Any doubts on this? So APV approach, first do a base NPV. What is base NPV? NPV ignoring the debt equity mix. NPV ignoring the debt equity mix. After the NPV is calculated, add the debt financing benefit. What is the debt financing benefit? Interest saving, tax saving, and in case it's a perpetual debt, amount of debt into tax rate, amount of debt into tax rate, and then bring in issue cost. After the issue cost is brought in, you will get the adjusted NPV or NPV under APV approach. Let's see one question here. I'll come to 26 first. Management of a multinational company, TL Limited, is engaged in the construction of an infra project. A proposal to construct a toll road in Nepal is under consideration of the management. Following information is available. Initial equipment will be in the purchase of equipment costing US dollar 250 lakh. This came in international capital budgeting earlier. Here it is like a normal capital budgeting only. Ignore the currency. Just read it as rupees 250 lakh. Just read it as rupees. The currency name does not really matter in the problem. The economic life of the equipment is 10 years. Depreciation will be charged on straight line method. 10 years straight line method. EBITDA to be collected from the toll road. EBITDA is earnings before interest, depreciation, taxes, and amortization is 33 lakh for a period of 20 years. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakh. USD 150 lakh at an interest rate of how much? 6% per annum. Interest is to be paid annually. Loan will be repaid at the end of 15 years in one tranche. So government is saying, you please do investment. We'll give a loan at what rate? 6% rate of interest. When I do base NPV, this information will be ignored. This information will be ignored. The required rate of return, if you do only equity financing, all equity financing is 12%. So first we will do base NPV at a discount rate of 12%. At a discount rate of 12%. Post tax cost of debt is, I'll convert the post into pre-tax to understand if there is an interest saving. If there is an interest saving, corporate tax rate is 30%. Can you do 5.6, 30%? What is pre-tax? 5.6 and 30%. 8%. 5.6 divided by 1 minus tax rate. Divided by 1 minus tax rate. So normally you should get a loan at 8%. But government is saying, I'll give you a loan at 6%. Why am I giving the loan? When I do base NPV, high probability it will be negative. High probability it will be negative. Project will get rejected. So if I have to encourage you, I have to tell you something. So two things I give you. One thing which I give you is lower interest. Second thing I give you is a tax saving on interest. Tax saving on interest. It is not that the government is giving, that is there for everyone. But when we initially evaluated, we ignored the debt funding and we calculated only the base NPV assuming what? 100% equity funded. What question wants? Advise the management on the viability by using APV approach, adjusted net present value method. Certain numbers have been given, calculations in USD lakh and round off to 3 decimal points. So let's follow whatever they have said, 3 decimal point. First I'll do a base NPV. In base NPV, year 0 outflow, then inflow over the life of the project, salvage value if it is there, and then we complete that. That is called base NPV. For base NPV, my discount rate will be 12%. For base NPV, my discount rate will be 12%. For tax saving, my discount rate will be pre-tax cost of debt. For tax saving, my discount rate will be pre-tax cost of debt. Issue expenses are not given in this question. Issue expenses part is not there. Working note 1, base NPV. Base NPV. Year cash flow PVF at 12%. All equity funded. PVF at 12% DCF. Year 0. Year 0. How much is the cost of the project? negative 250. Okay, you're going to leave some 3 4 lines. I'm giving you 2 3 minutes. What I want is the CF80. What is given in the question is EBITDA. From EBITDA, you have to subtract depreciation, no interest subtraction, no interest subtraction because equity funded. Then you will have to subtract the after depreciation is subtracted, deduct tax, add back depreciation, and then tell me the CF80 number. Do the calculation. Be a little cautious. 3 to 4 minutes. I am going to discuss it. I wanted you to experience this for 2 3 minutes. That's why I left it to you. When you evaluate any question, you will have to understand the cash flows little properly. Here it says EBITDA is for a period of 20 years. Depreciation is a period of for only 10 years. So technically I need two columns, particulars 1 to 10 and 11 to 20, which many notebook did not even factor in except for one notebook. Nobody else even figured this out, saying that depreciation is there only for first 10 years. Depreciation is not there after 10 years. So 1 to 10 will be there, 11 to 20 will be there. We start with EBITDA. In 1 to 10 you will subtract depreciation. 11 to 20 you will not subtract depreciation. 11 to 20 no depreciation subtraction, and that is why they gave 10-year annuity factor, 20-year annuity factor in the question. 10-year annuity factor and a 20-year annuity factor. For 10-year cash flow you will use a 10-year annuity factor. For 11 to 20 you will use a 20-year minus a 10-year factor. 20-year minus the 10-year factor. So you had to do calculation 1 to 10 separately, 11 to 20 separately, which many did not figured it out. Almost majority did not figured it out. So when you read the question, you will have to be, it's a very simple calculation. I keep doing it, you will keep understanding things. But when you read the question, it's at 33 lakh for a period of 20 years. Below above line said depreciation is only for a period of 10 years, which means after 11th year there will be a change in the cash flow. So here many did not do it. If you have not done, you can write it. EBITDA 33, 33, 1 to 10, 11 to 20. That's why I did not give the format also. I wanted you to experience it. 1 to 10, 11 to 20. No interest subtraction. It is base NPV means 100% equity funded. Base NPV means 100%. Some of you have tried subtracting interest. No interest subtraction. Minus depreciation. 25, 0. EBT 8, 33. 8 and 33. What is the tax rate given in the question? 2.4. 2.4. This is what depreciation contributes. When depreciation was there, we were paying lower taxes. That's the benefit of depreciation. EAT 5.6. Other number is I add back depreciation 30.6. The gap is nothing but the tax benefit on depreciation. The gap is nothing but the tax benefit on depreciation. Very few figured it out that 1 to 10 has to be done separately, 11 to 20 has to be done separately. Now, if you're not figuring this out, I have a lot to worry about, because point is you need to do on your own. I can keep doing any number of questions. If I had done this question, you would have thought it's a very simple question. What is there in the problem? But when I have just told you to do the cash flow calculation, some of you are struggling, some not, majority were struggling. Majority were struggling with the cash flow. Some of you subtracted interest. I have no problem with that, because that concept I have not explained fully. But depreciation was to be done 1 to 10 and 11 to 20 separately. If you do not figure that out, that is my worry. Any doubts on this number? Any doubts on this? Clear? Can you proceed? Go back to the table. 1 to 10. 1 to 10. 1 to 10. We have 30.6. 11 to 20. 23.1. 30.6 and 23.1. My sense is high probability will give negative NPV. That's what I remember. 1 to 10 given in the question. 5.650, 5.650. 11 to 20 is also given. 20-year annuity factor, remove the 10-year annuity factor. From 20-year, remove the 10-year. From 20-year, remove the 10-year. 20-year is 7.469. Remove 5.650. 7.469, remove 5.650. Question has told us to work with 3 decimal in the final answer. 23.1 into 1.819. 42.019. Let me know in case any calculation errors are there. Negative 35.091. So I went to that Nepalese government and I told them, where is the project viability? 250 crore, 33 crore collection and all is not sufficient for me. If it can, 33 can become maybe 43, it can become viable, but as of now it doesn't look viable. 35 lakh is the negative NPV. Then they said, wait, I'm giving you certain allied benefits. Let's take the benefit and then you evaluate again. Then you evaluate again. Any doubts on negative 35? Standalone bad project. Standalone bad project. Now I want to mix the debt part. I want to mix the debt part and see, because of the debt, is there any benefit? Because of the debt, is there a benefit? If that benefit is there, project can become viable. If that benefit is there, project can become viable. Issue cost is not given in the question. Issue cost can also be given. That will further pull down this 35. That will further pull down this 35. In 35 can become 40, 45 in case there are issue cost, which is what practically happens. If I do an IPO, I have to incur expenses on the IPO. If I take a loan, I have to pay some processing charges on a loan. So there will be issue cost in the practical world, which is what this APV approach is bringing in. Any doubts on 35? Next, benefit of debt. Benefit of debt. Year are particulars. Benefit PVAF and total value. Benefit PVAF and total value. Benefit PVAF and total value. First is tax saving on interest. Tax saving on interest. Tax saving on interest. What is the loan we are taking? 150 lakhs. What is the rate of interest we pay? And on that 30%. This is for year 1 to 15. 15-year loan. Every year same benefit, because question said loan is repaid at one tranche in the end. It says loan is repaid at the end of 15 years. Next session I'll be doing a problem where I have to do something like this. Every year you have to do interest calculation. Every year you have to do interest calculation, because there the loan was not repaid at one end. Here this question little easier, because loan is repaid at one tranche. The problem which I do in the next session, every year there will be a loan repayment. So every year interest will be different. Every year interest is going to be different. This question relatively simpler, because loan will be repaid at the end of 15 years in one tranche. If every year loan is repaid, then every year you have to calculate interest, which is a time consuming calculation. It's just a time consuming, which I'll do it in the earlier question. In the next class we'll see that. This, the amount is how much? 150 into 6% into 30. 2 point. PVAF at 8%, pre-tax cost of debt. It's given in the question. The PVAF is given in the question. At pre-tax cost of debt for 15 years, 8.559. PVAF is given. Present value interest factor of an annuity. A represents annuity there, and normal PVIF is normal PVF without the annuity. 8.559. 8.559. 3 decimal answer. 23.109. Now what this is going to do, this is going to pull down my, that is reduce the negative NPV by 23 lakh rupees. The negative NPV will go down by 23 lakh rupees, only the tax saving part. Second is interest saving. Interest saving 1 to 15 years, 150 lakh into 2% directly saved. 2%, 8% is the normal rate of interest. Government called me, said, I understand you have a negative project. Why don't you still do the project? Because I give you certain allied benefits. I asked them what benefit you want to give. They said, whatever interest you pay, we'll give you tax benefit on that. I said, that's okay. That is given to everyone. Then they said, second thing is, I'll reduce your interest itself. I'll reduce the interest itself. 3 into 8.559. 3 into 8.559. 25.677. This will now make the adjusted NPV positive. 48.786 is the benefit of the debt. Benefit of interest saving and tax saving. Benefit of interest saving and tax saving. Any doubts on this? Add them together, adjusted NPV. Negative 35. Adjusted NPV is 13.696. Adjusted NPV is 13.696. Company can go ahead with the project as the adjusted NPV is positive. The adjusted NPV is positive. Base NPV is negative. The base NPV is negative. Adjusted NPV is positive. Again repeating, we normally do not mix investment and financing together, because when you mix them together, you may end up taking wrong decision. But certain situation, because of extra benefits which are there, I may have to bring in the debt equity mix into picture or the investment mix into the picture, and then accordingly evaluate the project. Clear? Any doubts on this? Otherwise, normal approach, CAPM, asset beta calculation. You have to do asset beta calculation. RF plus asset beta into RM minus RF will be the discount rate. Complete it. No need to know what is the debt, what is the equity in the project. Any doubts on this? I'll end with this then.